Good evening, class, and welcome to our taxation class for today. Today we'll be doing two topics: taxation of employment income, which is called payee, pay as you earn, and taxation of settlement, trusts, and estates. So let's take the first one, taxation of employment income. You know, when we talk about employment income, we mean people who are employees. So there must be an employer-employee relationship. It is called contract for employment. So if you look at page 3, we see the things that makes the contract for employment valid. So you see that they receive what they call salary as their remuneration. They are also taxed on actual year basis. So the basis period is actual year. So in other words, if someone is being assessed to tax as an employee for the current year, 2020, the basis period is going to be January 1 to December 31st, 2020, actual year. Okay? And we look at what they called the income from all sources as an employer. So you have your gross income. Your gross income comprises of your salary and all your allowances. Then there's what they call benefits in kind. Benefits in kind also form part of your income. We'll talk about it. Then the rate of tax of the personal income tax of employee is the same as the personal income tax of an employer. It's also the same personal income tax of a partner. So it is this tax rate here that is 7%, 11%, this the graduated tax rates from 7% down to 24%. That is the tax rate. Now, if you look at the format here, this is the format for computation of tax liability. You need to find all the gross income, income from sources. Then you now remove all the income that are not subjected to tax. So every income not subjected to tax, you remove it. Then you have what they call gross income. So the gross income, you now less your relief. When you less your relief, the relief is, they will give you pension. If you have pension, they will give you National Housing Fund, National Health Insurance Scheme, then there is life assurance, then there is gratuity. All these are reliefs. Then consolidated relief allowance, CRA. Okay? Now, in real life, you may only have at least 2 reliefs, which is the CRA compulsorily and the pension. The others are optional. That is if the taxpayer has indulged in any of them. In the exam, they won't give you CRA. You are the one to find CRA. In the exam, if they didn't give you pension, you may not need to do pension. But in real life, if your company is participating in the approved pension scheme, it is 8% of employees' salary that goes into pension. So when you deduct all of this, you get what they call chargeable income. It is from the chargeable income that you compute your tax with that tax rate. So you see that The first one, 7,000, 7% gives you 21,000. Cumulatively is 21,000, like that. So you have to look for your tax liability using this tax table. Now, when you get your total tax liability, if there is any withholding tax that you have suffered, now we put that withholding tax suffered in the case that this employee is also a business person that did business, and after bringing all this income from all sources, he must have suffered withholding tax. And so he's going to deduct his withholding tax from his tax liability to get what they call final tax liability. So that's basically the format. Now let's look at a question. Exercise 3.1. Mr. David Olaleye retired from the employment of the Ministry of Water Resources. Now this is government work. Ogun State of Nigeria. So the tax authority here is Ogun State, as at when he was working then. Okay? He retired on December 31st, 2012. So of course, when he is retired, he will be paid a gratuity of 4 million on retirement. So this 4 million was paid on December 31st, 2012. So if the next set of information we are going to talk about, if it relates to 2012, that means gratuity is an allowable expenditure or allowable relief. But if what we are talking about next is going to be in 2013, then anything that happened in 2012 is not our business. He secured employment with OLAC Limited on January 1, 2013. So you see, we've left the business of 2012. He gained the admission employment as a senior marketing manager on a salary of 8,400,000 naira per annum. So that's his annual salary. He is married with a wife and has 6 children. We're not interested in that information. It has no benefits in tax. His record at the end of the first working year in the new employment, what are they talking about? 2013, January 1 to December 31st. That is the end of his first working year. Revealed the following information. He was given an official car with market value of 2.5 million. Now, official car that was given to him is what they call benefit in kind. He didn't get the benefit with cash. They gave him in the form of a car. And so that car, he did not buy it from his own purse, from his own pocket. Employer bought the car and gave to him. The tax authority looks at that action as having more income. But of course, if the employee buys his own car by himself, that's a different thing. But now the employer is buying a car for the employee for his official function. So it's as good as paying the employee more money. So the tax authority look at it that way. And so what they do here is, you cannot just deduct the whole sum of the car in 1 month or in 1 year. So what the authorities do is to spread it to 20 years. How do they spread it to 20 years? They take 5% of the value of the car as benefit in kind. 5% of the car as benefit in kind. So that means after his salary of 8.4 million, they are going to add 5% of the car value as part of his income. Now, the company pays 820,000 naira per annum on his official accommodation. Now, once again, the company is the one paying from their purse. He is not paying anything for his accommodation. So the tax authority looks at it that this didn't come from the taxpayer, it came from the boss. So that is an additional money given to the tax authority. So they will look at this accommodation that they paid for you as an additional tax in your hand. They will look at it as an additional income in your hand. Okay? He has a life insurance policy with Okonkwo Assurance PLC. Now, this life insurance policy is allowable. The sum assured is 480,000. We're not interested in the sum assured. We're interested in your premium that you are paying. While the monthly premium is 4,200. So this is monthly premium. You have to get the annual premium by multiplying by 12 months. He contributes 20,000 monthly to an approved pension scheme. It must be approved pension scheme, otherwise it will be disapproved. So this is a monthly contribution. So you multiply 20,000 by 12. He spent 17,000 naira during the year for the upkeep of his aged parents who have no source of income. That information is of no value to tax for the current tax regime. It's because there is what they call CRA. All your parents' upkeep, your sibling upkeep, dependent upkeep, everything is inside the CRA. So 17,000 naira has nothing to do with tax, so it will be ignored. He contributes the sum of 15,000 naira per month to National Health Insurance Fund. He multiplied by 12, that's allowable expense, and 20,000 naira per month multiplied by 12 in the National Housing Fund. Required, compute the annual and monthly. So there are two questions, annual and monthly tax liability for the relevant year. So what is the relevant year here? The information they gave you relates to his first year at work in this new employment. His new employment is 2013. When assessing a company, an employee's income to tax, the basis period is actual year. So that means the relevant year of assessment is 2013. So that's it. Now let's look at it now. The first thing is the income. We have salary is 8.4 million from the question. Then we have benefits in kind. The first one is official car. We said before we are going to use 5% of the car value. That is what will be used every year. 5% on cost. So that means it is spread out for 20 years. Of course, the car cannot last for 20 years, but that is how they use the conservative principle for 20 years to take that income in the hands of the taxpayer. Then we have the official accommodation. That money that was paid on his behalf, they use it to increase his gross profit. So it's one thing for your employer to pay your house rent for you. So if your employer pays your house rent for you, you are increasing your tax that you pay to the government. So for paying the house rent for you is as good as giving you the money to pay the house rent. Now you paying the house rent has no significance to tax because this is your living apartment and it's not a business thing. And so it's not an approved expenditure. So, but the money that was paid on your behalf is as good as given to you as if you are earning more income. Okay? So the official accommodation, 820, is also added as benefit in kind. So you add the two of them together, you have 945,000. Add it to your salary, you have 9,345,000. Now that is your gross emolument. If there are items that are in this income that are not supposed to be taxed, this is the time we would have deducted it. That means if there was pension received in 2013, it would have come in as part of the income and go out as part of the non-taxable income. If there was dividends received, it will come in and it will also go out as franked investment income. Okay? But now there is none. So your gross emolument is also the same thing as your gross income. So the next thing to do is your relief, tax exempt relief or allowances. The first thing you should always do is your CRA. It is never going to be given to you in the question, but you should do it first. Now, what is CRA? The government says for every year, will allow you 200,000, a flat rate of 200,000, or a flat or 1% of your gross income, whichever is higher, you take it. So if 200 is higher than your 1% of gross income, you take 200. If 200 is lower than your gross income, you take the 1% of your gross income. After taking that higher one, you also add 20% of your gross income. So look at what I usually tell my students. Okay? If I give you 20 million today, and I say find 1% of 20 million, 1% of 20 million is going to give you 200,000, right? That will mean that anything less than 20 million, if you look for 1%, it will be less than 200. Anything more than 20 million, if you look for 1%, it will be more than 20 million. So what I tell my students is this: look at your gross income. And if your gross income is not 20 million and above, just put 200,000, because 200,000 will always be more. But once you see 20 million, more than 20 million, put 1%. In fact, just go straight and write 21%, because you will still do that second 20%. So once it is more than 20 million and above, once it is 20 million and above, just use 21%. That means the first 1% of that figure and the 20% of that figure. But if it is less than 20 million, you take 200 first, then you do 20% of that figure and you add both of them. So if you look at it, this is 9,000, 9 million rather. That's why 200,000 is higher. And we now did a 20%, which gives me 1,869,000. You add them together, you have 2,069,000 as your CRA. Now we'll continue. What are the other things we are going to add? The next one is contributory pension. The contributory pension here, the actual contribution here is 20,000 naira a month times 12 months, which gives me 240,000. We were told to look at note 1. If you go down, you will see note 1. It said by law, he is statutorily required to pay a minimum contribution of 672,000. This is 8% of his salary. Now, 8% of his salary, 8,400,000. Normally, it's supposed to be 8% of his basic, his transport, and his housing. DHT or BTH. DHT. Basic, housing, and transport. But sometimes, some company manipulates these figures such that if they don't want to give you, if they don't want you to get plenty allowance, they can give you a high allowance by making your basic too high, transport too high, housing too high, so that your contribution might be high. Or they might make it too small. Too small. When they make it too small, what the employer is going to contribute is going to be small. And what the employee is going to contribute is going to be small. So when they make it like that, and they pay very small amounts, and the employer is the one cheating you. They are paying small money into your contributory pension, and it is also making your tax higher, because small relief, bigger money to be taxed. So most companies naturally do 8% of your gross, because there is no standard percentage of your basic that should be for transport. There is no percentage of your gross that should be taxed as that should be considered your contributory pension. So some companies use 8% and 10% respectively of employee and employer. So if that's the case, you should have paid 672. But in the exam, you should use the actual contribution given to you. But in practice, they won't give you actual contribution. You will calculate how much to be deducted at source. Okay? That's just what I want to note there. So we have used the actual, which is 240. The next one is the life insurance policy, life assurance policy. Now, all these ones, life assurance, anything he pays as premium, 4,200 times 12, that is what you are going to use. We have the National Health Insurance Fund. I think there is it's what you and the HMO discuss, and what you pay, agree to pay, is what will be used. So this is like 15,000. So it depends on the plan. It depends on the plan that you have used. So that's okay. National Housing Fund, there used to be a percentage. Is it 2.5% of your basic salary? If you are doing it for real life, it's supposed to be 2.5% of your basic salary. But in the exam, whatever they tell you, that is what you should use. So you multiply by 12, and you add all the relief together, and they give you 2,779,400. You will not deduct this relief from your gross emolument, and you have what they call the taxable income here, which is 656,600. Okay. Then now it's time to compute the tax. It is based on this 6 million stuff that you are computing the tax. Okay, so we go to the tax table. Now, once your tax is more than 3.2 million, that means that everything will get to 24%. If it is exactly 3.2 million, everything will end at 21%. If it is exactly 3.2 million, everything will end at 21%. Once it is more than 3.2 million, then you know it's going to get to 24%. So you now look at it, it's more than 3.2, it's up to 6 million. So you know that it is going to get to 24%. So I'm not too excited at all this because you must have crammed the tax table. So 21%, 33, 75, 95, 336. These ones should ring in your head because these are the ones that is normally given. Sometimes it might get to that amount. Now, the final part, after you've done up to 3.2 million, you now look at the balance and tax it at 24%. So how do you get your balance? You will say your whole taxable income minus 3.2 million. That is the balance. Because if you look at it, the first 300 plus the next 300, that's going to give you 600 plus 1 plus 500 plus 500, that's 1.6. If you add another 1.6, it's 3.2. That means you've dealt with 3.2. The next thing to do is to remove 3.2 from it. The balance that is left, you multiply by 24%. It gives you 807,744. So when you add them together, you are having 1,367,744 as your annual tax. Remember, the question says you should do annual and also monthly. So what will be your monthly tax? Your monthly tax will be your annual tax divided by 12, which will give me 113,979. Now that is your part A answer. Okay, so now let's get to part B. The question here in part B says, compute is annual and monthly take-home pay for the same relevant year. The same relevant year is 2013. So what is his take-home pay? How much is he taking home? The take-home pay is your gross earnings or emolument, which you've calculated as 9,345,000 minus all the things we've deducted. So we've deducted contributory pension, which is contributory pension is 240. We've deducted life assurance, which is 50,400. We've deducted National Health Insurance Scheme, which is 180. We've deducted National Housing Fund 240. We've deducted payee, which is our final, the tax, the yearly tax. All these ones are yearly. We've deducted the yearly tax of 1,367,744. But there is something we deducted that we didn't add here. We deducted CROA before we got our tax. CROA is not an expense. CROA is not an expense. It is not the deduction. That deduction doesn't mean that it is deducted from your salary. That deduction was deducted temporarily so that we can find what our tax is. So that when we find our tax and remove our tax, we add it back. So that CROA is still given to you to use to sort aged parents, dependents, and all that. So we don't deduct it as to get take-home pay. The CROA is part of your money. The only thing we deduct that we will have spent is on tax, pension, life assurance, National Health Insurance Scheme, and National Housing Fund. If there was gratuity that we deducted as relief before, it will not be deducted here. So now your take-home pay yearly will be when you less all those deductions we've talked about from your gross emolument. You are having 7,266,856. That's your yearly take-home pay. If you divide that by 12, you have 605,571 as your monthly take-home pay. So that's going to be your monthly take-home pay. So note the two difference. When you are doing tax, you deduct all your reliefs. When you are doing your take-home pay, the reliefs that are not statutory, not actual deduction, is what those ones don't get deducted. Like typical example, CRA and gratuity. These are just deducted temporarily because of tax. And so when the tax is deducted, you add those ones back. So that's fine. So that is how you do your company income, personal income tax for payee. Actual year basis, all your income from all sources, salary, basic, all that. You get gross emolument, remove all the income that are not subjected to further tax or that are not taxable. You now have gross income. Gross income, you less your relief and allowances. CRA, pension, housing fund, health scheme, life assurance, gratuity. So you should know those formats. Then you have your taxable profit or chargeable profit, from which you now charge tax. Graduated rates. And I told you for CRA, you look at 20 million as your benchmark. If your gross income is less than 20 million, you just take 220% of it. If it's 20 million and above, just look for 21%. So that's it. Then we will now go to the next topic, which is called taxation of settlements, trusts, and estates. Settlement, trusts, and estates. Now, a trust is created when somebody is passing over his belongings or estate to another person. And that's what they call trustee. You get a trustee when more than one person is a named beneficiary, or when a beneficiary is a child, you have a trustee. And so the trustee is the person who prepares the accounts of the estates. Okay? Now, the basis period for this account here is preceding year basis. Is a preceding year basis. And there's something like commencement rule and cessation rule. It means that from the date the trust was created, okay, from the date it was created and it went into effect, for that first year is going to be from that date to December 31st. Then thereafter, every year, we'll be considering December 31st. So by default, it's the accounting year for trusts and estates and settlements is December 31st. Now, on the last year in which the settlement is actually settled and no further settlement will be made, it will be from January to the date of final settlement. Now look at this example, exercise 3.2. Mr. Arewa created a trust for his 4 children. These 4 children are a day. Okay, let me make it easy. In place of a day, I will call it A. Garowa is B, GD is C, and then 4 is D. So it's A, B, C, D. The records of the trustee for the year ended 31st December 2010. You underline that date. That's the end date. So you should know that it must end in 31st December. Anyone that does not end in 31st December, it means that year is a final payment year. Okay? 31st December 2010. What's going to be the year of assessment? You're right, 2011. Now, look at what the information revealed. Profit from trading activities is 980. That's fine. Interest from fixed deposit is an income. Rent from property, gross. So it is gross. Rent and dividends are always taken gross. Rent, dividends, interest. We always report them gross. These are investment income. So if you see here, business income is trading, fixed deposits and rent are investment income. Now, other income could comprise partnership income. It could also be income from employment. We don't know. It could also be sale of non-current assets, and you have an income. Fine. All right. Other related information includes the 4 is to get a fixed annuity of how much? 35,000 naira per annum. So this fixed annuity makes him a fixed annuitant. So this fixed annuity is deducted before we get what they called computed income. Okay, then we also have the remuneration of the trustee. So the trustee should be paid. All these are allowable expenses. The trustee's payment is fixed at 20,000 naira per month. So that's a fixed cost plus 2.5% of computed income. So that's a variable. So you see, you have to find the trustee's income before you compute the computed income. But now they said it should be 2.5 of the computed income which you have not computed. So what we do is we treat it the way we treat VAT when we are saying VAT inclusive. So if somebody tells you that this thing I have bought here is 107,500 VAT inclusive, that means VAT is included. How do you get the VAT inside? If VAT is 7.5 and it is included, so the VAT will be 7.5% all over 107.5% because that 17,500 has VAT inside. If it was VAT exclusive, it would have been 100%. But since it is VAT inclusive, it is 7.5 over 107.5. And that, bringing that idea to here, if this 2.5 is included before computing the computed income, it's going to be 2.5% all over 102.5. That would mean that you would have computed every other thing and let that 2.5% be the last. Then we now have the allowable expense of the trustee amounted to 25,000 naira. Okay, they said the trustee made the following discretionary payments. Now, discretionary payment is not included as allowable expenses. This discretionary payment is what should have been shared to the beneficiaries, but they are not paying it. It's like a part payment of what they are supposed to be shared. It's a discretionary payment. So just know that fixed annuity to the beneficiary or to the annuitant is allowed, but discretionary payments are not allowed. It is part of appropriation, and appropriation are done after you have computed the computed income. That is when you do discretionary payment. The things you are going to do under that is discretionary payments, capital allowance will be deducted from business activity, discretionary payments, and distribution of income. So if you look at half of the net distributable income of the settlement is to be shared equally among the beneficiaries. So that means that after you've gotten your net distributable income, let's assume it is 1 million. You will not share half of 1 million, that is 500,000. That 500,000 is what you are going to share to all the beneficiaries A, B, C, and D. Who has the remaining 500? The 500 that is remaining will be income in the hands of the trustee. All of these will be charged to tax. The trustee will pay his own tax from his own amount. All other people who receives money will pay their tax from what is in their hands. Now, you said here, we are required to calculate the income of the settlement chargeable in the hands of each of the beneficiary, and B, for that in the hands of the trustee. So this is how we do it. Okay. Now, if you look at it here, it has been how many columns here? 6 columns. There is a column for total, and there are subdivisions for all the beneficiaries. So that total there represents the trustee. So instead of writing total, I can put trustee there. So profit from trading. So you see there, 980. You have to remove capital allowance from it because capital allowance must be from trading. So you remove capital allowance from the question from trading, and you have 985,000. You continue. What of interest received on fixed deposits? We are given 270. Rent from property, gross rent received, we have 620. And the other income, of course, we have 163. When you add them all together, you're having a gross income of 2,011,000. So that's your gross income. What are your allowable expenses? So we said the fixed annuity, we are giving fixed annuity in the equation 35,000. And we were told that this fixed annuity was to Darfur, 35,000. So if you look at the question here, 35,000 was in bracket, that's an expenses. And 35,000 to Darfur was not in bracket because it was received by Darfur. Then the next one is allowable expenses of trustee. So you see, we have allowable expenses, although the allowable expenses came down. Allowable expenses came down. The allowable, after computed income, they talk about computed income. So that shows that you don't have to check, have to start writing everything out according to how they give you. Because I told you that the one that talks about computed income will come last. So that means the fixed and the variable fee allowances will come last. So this one is allowable expenses of the trustee. So the allowable expenses, these are expenses made by the trustee that are allowable by law. It's 25,000. Then when we do that, we'll now look at the remuneration of the trustee. We said the first one is 20,000, which is fixed. Now the second one is 25% on computed income. We don't know our computed income. So how do we do it? All we need to do is we look for the net by looking at our gross income minus all other expenses, which includes fixed annuity, 35,000, allowable expenses of trustee, 25,000, and the fixed remuneration of trustee, 20,000. When we do that, we'll have a figure. That figure, that is the figure we are going to remove our variable remuneration. So it is that figure we are going to check for 2.5% all over 102.5. 2.5 over 102.5. Not 2 over 5 over 100. Not 2.5 over 100, but 2.5 all over 1.120, 102.5. So you see there, you have 47,090 naira. So when you minus all of this, your computed income is going to give you 1,883,902. Now, as a test, if you look for 2.5 of that computed income, that is by saying 2.5 all over 100 times 1,883,902, it will still give you your 47,098. So that's how you know you've done it well. After doing that, then we now have discretionary payments. Discretionary payments. So before you find the total discretionary payments, you put down all the payments to each of them that they give discretionary payments. Then you add them up. It becomes 105,000. So 105 is being bracketed in the total column, but in the other columns for all those other people, they are on their own. They didn't put them in brackets. Excuse me? Meaning that it is an expense to the trustee, it is an income to the beneficiaries. When we deduct the discretionary payments, we are now left with the distributable income, which is 1,778,902. So it is that is distributed. Now look at the income distribution. We were told that half of this 1,778,902 is being distributed. So that's why you see me, I wrote 1/2, which is that half, is going to be distributed to 4 people. It's going to be distributed to 4 people. So half alone, half of that 177,902, that half is going to give you 889,451. That is the half that is being distributed. So you see, that's why I bracket it. But the distribution, you have to divide it by 4. That's why I did the division by 4 here. I have 222,363. So that is how you spread that same amount to everyone If you add all of them, it's going to give you 889,451. So that's simple as that. Then income in the hands of the beneficiaries. All you simply do is add all the positive income that came to them. For a day, you add the 40,000 to the 222,363. You have 262,363. You do same for Barua, you do same for Chidi. For Darfur, you have to make 3 additions. That's fixed annuity, discretionary payment, and the income distribution. That being said, the undistributed income, which remains with the trustee, is going to be the distributed income, distributable income minus the one that has been distributed to the beneficiaries. So if half was distributed, that means half will still remain with the trustee. So that means that the trustee will find tax on 889,451. He will pay tax on behalf of the person who created the trust. While the beneficiaries will pay their own tax on their own basis, on their own income. So it means that if somebody who, like, let's say Darfur, this trust is part of his income. This maybe 272,363 is a part of his income that comes to him. Maybe he does his own business and gets business income. So, a direct question, we say other incomes. So this income could be all these other incomes that is coming to him. So this could be just one. There are some people who this is just their income. So what you will do is, for all others, you look for tax on their own income. So for trustee, this trustee here is doing business. The trustee is like doing business. And so there is no it's going to still charge what do they call it? Personal income tax, 8% and 7%, all that like that. But you will not do something like this. You will not do CRA for the trustee. You will not do CRA, pension, and all that. You will not do all that for the trustee. But for all other beneficiaries, you can do that because they are living persons. The trustee is representing somebody who created a will, to be somebody who is dead, created a will. So, but for the trustee, that total column, you don't do all CRA and all that. Pension, life insurance. But for all other beneficiaries, you can do that. So these are the 2 topics that we had today. So that's for this week's topic. There is this other topic we didn't finish last time, which is called loss relief. So since we have time now, I will use this moment to take loss relief. Sorry, let me look for it. Sorry. I'm trying to look for the other documents that contains the lecture. For me, 21 should be this. Okay. So Yes, on page 13 is our loss relief. So let's talk about loss relief briefly before we call the class. Now, loss relief is when a business makes loss. When a business makes loss, it carries its loss to the next year. When it carries its loss to the next year, it is called carry forward loss. When a business makes a loss this year, it is called current year loss. And so one of the principles of loss, which you should know, is that losses can be carried forward. But when you also carry loss forward, you cannot relieve a loss that is greater than the actual loss incurred. What I mean is this. You know, in commencement rule, when you are doing commencement of business, you know, because of overlap, the overlapping principle, 2 years might overlap each other. So you may have loss that is in the first year, which is also being used for the second year, and perhaps for the third year. Depends on how you see it. Now, this loss, let's say it is 1 million naira for the first year, and that same amount is being used as the loss for the second year. It will look as if it is 2 million naira that you want to carry to the next year. For Haba, it's only 1 million naira actual loss that you've made. So in as much as it looks like 2 million naira from the principal, the actual loss to be carried forward is 1 million. But for profit, you are taxed 2 times. Even if this 1 million naira, you are taxed 2 times. So you see the cheating that is being made. For profit, you are taxed. And if it is overlapped, you are taxed again. But for loss, you are not allowed to double it like that. Although the new finance bill have taken care of all that. So let's look at one question here and ascertain ourselves that we know it. Now look at Dominion Enterprise commenced business on July 1, 2004, and look at the following results. So because this is the business, is preceding year basis now, it said commence business. So the commencement rule holds. Now we are told that the first year, which period ended 31st December 2004, that will be 6 months period from July 1. We have 180,000 as our loss, capital allowance, that. So we are told to compute the total income or loss of the business that is accessible for the relevant years of assessment. And we are told to ignore right of election. So when they told you to ignore right of election in commencement rule, you do so. If you don't hear that language, you will do for right of election. Now look at it here now. The first year is 2004. Accessible loss, because it's loss there, they give you a figure for 6 months. So you put the whole 120, the capital allowance is 30,000. So you cannot carry capital allowance to relieve it from loss. So you carry both the loss and you carry both the capital allowance. And so your profit is 0. The next year, 2005, you know, for accessible profit or loss, you start counting from the date the business started and count 12 months. So the date the business started is still July 1, 2004. You need 12 months figure from the beginning. You see, the first loss, 180, is a 6 months figure. We still need another 6 months figure to make it 12. So we go to the 120 and take 6 over 12. If you add 6 over 12 of 120, which is 60,000 to 180, you have 240 as your loss for that year. 240. Now bring the loss from last year, which is 180, and add it to 240. All you have is total of 420. But is 420 your actual loss? No. The actual loss is not up to 420. What is the actual loss so far? The actual loss so far is the first 120, 180 you've taken from the first year. And remember, you took 60,000 from the second year. This is the actual loss since you started. 180 plus 60, which is 240. So instead of carrying 240 instead of carrying 420 to the next year, you are taking it as 240 that will be carried to next year. But your capital allowance for the year now is 40,000. Bring that of last year, 30,000. It becomes 70. Since there is a loss, you carry the 70,000 capital allowance to the next year. Total profit is 0. For the third year, 2006, we have assessable loss for the year. Now, assessable loss for the year is 120. Now, how do we, our 2006 year of assessment is preceding year basis. Preceding year basis is 2006, that means it must end in 2005. The account year end is 31st December, so it must end in 31st December 2005. So that means it must have started January 1 to 5. So look at the account that has January 1 to December 31st to 5. Is still the loss of 120. So that is the loss for that year. Bring the loss from last year, which is 240, and add it to the loss of this year. We are having 360. But is this 360 the actual loss? No. Go and look at it again. We have 180, which is the one from the first year. And mind you, you are taking the whole 120 for the second year. So 180 plus 120 is how much? 300. But here you are, you're having 360. So that means 360 is not the actual loss, but 300 is the actual loss. So that is what will be carried to next year, not 360. So 300 will be carried to next year. Now your capital allowance for this year also now is 40,000, but that of last year is 70,000. So you are carrying 110,000 to next year. Profit remains 0. Now the next year, you made a profit, accessible profit of 140. That's commendable. But of course, you have a loss brought forward from last year, 300,000. So when you deduct the loss from your profit, it means that the total loss available is now 160. So you have cleared up to 140,000 naira loss. So the remaining loss is 160. Your capital allowance for the year is 45,000. Remember, you have 110 last year. You now bring it. Everything becomes 155. There is no way you can clear capital allowance on this loss of 160. So you are carrying 160 loss forward. You are carrying 155,000 capital allowance forward. Okay? You now have in this new year, we have 260 as our profit. You are happy you are making consistent profits. But now Your loss of 160 is going to affect it. That means 260 minus 160, you have a profit. Before I talk about this now, when you have a profit of nil from last year, because you have 140,000 naira as your profit for this year, you're going to pay education tax, 2% on that. That's what I wanted to note. Okay, now this year you have 260 profits, the loss of last year 160 affecting it, giving it a net accessible profit of 100,000. Wow. So you now have what you will use to relieve your capital allowance, 100,000. Now your capital allowance for this year is 50,000. Remember you have from last year 155. You add them together, it gives you 205. You can relieve some part of it. So how much are you going to relieve? Your loss to be, your capital allowance to be relieved is going to be 2/3 of 100,000, not 2/3 of 260, 2/3 of 100,000. When you compare it with that of 205,000, find out that 2/3 of 100,000 is smaller, which is 66,667. So that is what you are going to relieve. So you see, from last class, I told you write it in two places. The first place you are writing it is to show the balance that will be carried next year. The second column you are writing it to give us how much is our taxable profit. Our taxable profit is now 33,333. So you can charge your tax from 33,333, 30%. If it is company income tax, if it is personal income tax, you use your graduated tax rate. If it is company income tax, you charge your education tax 2% on what? On what? On 260,000. So remember, the first accessible profit, 260,000, you link education tax to it. The second annual accessible profit you've computed after you relieve your loss, that is where your capital allowance will be charged. Now you now come to the last year, you have accessible profit of 400,000. There is no capital allowance for this year. Meanwhile, we have the remainder from last year brought forward. So since there is no one this year, the one last year becomes the total capital allowance. How much is to be relieved? When you do your 2/3 of 400,000, what you will get is bigger than what capital allowance you have now. So you are relieving the whole capital allowance. So if you see there is no balance to carry next year, but we have a profit of 261,667. That is the profit that you'll be charged to tax from. While your education tax will be charged from 400,000. So now this is how we do our loss. Each time there is a loss, you can carry it to the next year. Carry it to the next year. But mind you, you have to be checking the period you are taking the loss. What is the total loss that you have accumulated so far? And what you are carrying, is it more than the actual loss? So always be checking, be conscious of the actual loss. Conscious of the actual loss. You should do that in the commencement rule, the first year, the second year, and the third year. Be watching out for the actual loss if loss is continuing. Then, if loss enters the fourth year, you might find out that the fourth year is only the fourth year loss. Okay, the actual loss would have been established from the third year, which you are carrying forward to the fourth year. So from the fourth year, when you get your loss, you will no longer be saying subjected to actual loss from the fourth year, because there will be no overlap. Because when there is overlap, that is when you are thinking about what is the actual loss. So from the fourth year, fifth year, even if there's loss, fourth year, fifth year, you will be adding them, but you will not be saying subjected to actual loss. Then the principle of commencement, the principle of cessation applies. But when it gets to the last year in cessation, any loss you establish there become lapsed. You cannot carry it forward anymore. Neither can you carry backward. For your capital allowance, you know that when you get to the cessation period, you take it backward 5 years. So you see, that's the difference between capital allowance and loss relief. So far, so good. We've seen three things. We've talked about three things. We've talked about personal income tax. We said it's actual year basis for payee employment income. We talked about the income that are subjected to tax and those ones that are exempt. We talked about the relief that are allowable. We talked about CROA not being given in the question, but you have to do it. And we got a threshold of 20 million. We talked about our take-home pay, how we can calculate take-home pay, annual and monthly. We then went to trusts, settlement, and estates. And we now said it's preceding year basis. The trust represents the person who is creating the will and all that. We said that trust, that total, you will not have things like CROA and other things being done to it. Pension, no. And he pays the tax on behalf of the person who created the trust. While the other beneficiaries, what they receive in their hands is subjected to personal income tax. Now, to them, they are charged on an actual year basis. If it is employment, if they're including employment income, that is what makes it actual basis. But if it is not employment income, if employment income is not added to it, that is charged on preceding year basis. So, but what happened is that you will take all the benefits that they get and sum it together to get income from all sources. So as you are deducting it from the trustee, you are adding it to the beneficiaries. We said allowable expenses include fixed annuity, allowable expenditures made by the trustees, and the trustee remuneration. So these are grouped into three things: fixed annuity, allowable expenditure made by trustee, and trustee remuneration. When you deduct all that from the trustee, which is the total column, what you have is your computed income. From your computed income, you can make discretionary payments. When you deduct discretionary payments, you have your distributable income. It is this distributable income, you will not distribute it according to the sharing ratio. I believe you've done partnership income. It's like that pattern, the sharing ratio. You may not share everything, so some will remain in the hands of the trustee. So that is the income in the hands of the trustee. Then for that of the beneficiaries, you add them to get income in the hands of the beneficiary. Then we've seen loss relief. Current year loss. What I mean by current year loss is that the loss you get in the current year. So now, if it is an individual, current year loss from all the sources of income, you can take a loss, maybe loss from this line of business, you can, how will I call it, relieve it from all other sources of income for that year. But if you cannot relieve everything from that year, the balance will be carried to next year. But that balance that is carried to next year cannot be relieved from all other sources of income. It must be relieved only on that line of income. Let me give you an example. Let's say you're into computer accessories and you're into selling of foodstuffs, and your computer accessory business made a loss. And you're also into rental properties. So your foodstuffs had a profit that year, your rent has a profit that year. You aggregate all your profits and try to reduce your loss. And you still find out that you made a net loss from electronics. Maybe 200,000 is the net loss. You take it forward. If you have 100,000 for electronics and you have 500,000 from all others, that is 500, 500, 100, which is 1.1. You are bringing your 200,000, but you're not going to relieve it from the 1.1. You're going to only relieve it from the electronics line, 100,000. So only 100,000 can be relieved. The remaining 100,000 will have to be taken to the next year. That is what we mean. And now we said, when you are relieving loss, you should be checking to make sure that it is restricted to the actual loss and not overshooting it. But all these have been cleared by the new Finance Act 2019. So I would like you to pay attention to 2019 Finance Act and see how the law has solved all of these problems of these tax matters. So that's what I would advise you to do. But it's not going to come out in the exam, but just for knowledge sake, so that you can be an all-round tax practitioner or tax student. So thank you so much for joining the class today. And the next time we are going to look at, I think it's going to be our last class. We're going to see if we can take the remaining topics in the next 2 hours and see how we can solve them. Any question, please send it to the WhatsApp group so that we can trash them. Thank you so much for coming to class. I didn't see any questions, so I believe yes. If you have a question, ask it in the WhatsApp forum, like as I said. Thank you so much. See you again.